inflation is the problem and might remain the problem. We actually think there are signs all around the world that deflation will be the bigger problem. And as I understand from this conference, I don't think the word deflation has been mentioned here. So I kind of like that. If everybody is sure something's happening and you have evidence brewing that that might not be true.
Hey guys, welcome back to Library of Wealth. In today's video, we have the CEO of ARK Invest, Cathie Wood, giving us a market breakdown, as well as the inflection points the Fed will need to pivot on. Wood believes the economic indicators all point to a recession, with deflation and negative prices coming in the last few months of the year. Cathie believes we're living in unprecedented times as we wait for interest rates and inflation to go down. Economic activity in China and Europe seems to be having a significant impact on the United States. Let's check out this interview with Cathie Wood as she gives us her market predictions for the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
We do have a point of view, though, on deflation from two angles. Cyclical, in the pipeline, commodity deflation is proliferating, and then downstream at the consumer end, and this is globally. We are being overwhelmed by inventories. So we believe in this holiday season that will become clear. It was interesting to see the online expectations for this holiday season, only 2.5%. That doesn't allow much room for real growth or inflation, right? Something's wrong out there, number one. And then the other thing is innovation, especially the amount of innovation that is evolving today, is inherently deflationary. There are massive deflationary undercurrents. And the base of these new ways of doing things is getting high enough to start moving the needle. So I believe in the next 3 to 6 months, you're going to hear more talk about deflation. What we have in the Fed is really a Keynesian Fed that does believe that inflation and demand are positively correlated. The history in the 80s, 90s, and the 2000s is that is not true. When growth picks up, productivity picks up, right? And that is a potent anti-inflationary force. The other thing that's going on, and it's been interesting to watch the surprise around the dollar's increase, 25% in the last year. That's another powerful inflationary, anti-inflationary force. So
in this country anyway.
In this country, but what the problem in the emerging markets, it's crushing them. Why? I remember, I've been in the business for a while, as most of you know. In the early 80s, the dollar did the same thing in response to monetary policy. And we ended up in the Plaza Accord and the Louvre Accord, where all of the treasury ministers around the world, including our own, decided to sell dollars and buy those other currencies because that dollar increase was becoming deflationary. Why? Dollar-denominated debt, right? As their currencies are falling apart, their ability to service dollar-denominated debt is disappearing. And that's why many of them are going to the IMF. You've got the IMF, the World Bank, and one other organization basically saying, do you understand what's going on out here? The US doesn't. It really doesn't. We are somewhat myopic, and we are the strongest economy in the world, but it's going to come back to bite us if we're not careful.
Cathie believes the Federal Reserve is making a huge mistake with their monetary policy and thinks that more pain is coming for the housing, credit, and crypto markets in the coming months. Wood believes the drastic actions by the Federal Reserve are crashing the market, but says that these actions are resulting in suppressed pricing, which provide the savvy investor with substantial investing possibilities.
We believe that most people are most investors, portfolios, asset allocators are truly short innovation unless they're highly involved with the private markets. Because we believe, and just to give some numbers, that innovation, truly disruptive innovation will scale from 7 trillion in market cap today to 210 trillion by 2030, from less than 10% of the broad-based public equity market to more than 60%. And so if you're short innovation, you're going to be missing some of these unbelievable opportunities. As we realized what a problem we had on our hands, the globe had. I think the markets were down in 1 month's time, 25%. We were down 46%. From those lows, as you just said, we from April 20 to 21, 350, 360%. Since then, just to keep the keep the perspective here, down 75% at our low in May. Now we're probably testing it today as we speak, so we shall see. I think one of the things that has happened is during risk-off periods, we see a rush back into indexes. Even so, a lot of the market's gone passive, but when we move into risk-off, this idea of career risk, business risk surfaces in discussions, and there's a movement back into benchmark stocks. We don't own the big benchmark stocks. Only one of our stocks has made it into the benchmarks, and that's Tesla. And believe it or not, Tesla's held up better than our portfolios, right? So I think there's been a lot of algorithmic trading. I felt it pre-COVID, the variables algorithms focused on cash burn, cash cushion. And yet at the time we were saying, wait a minute, this makes no sense. This is COVID, and we need to solve this problem. Innovation solves problems. And so that was one of the reasons we had that swoosh, right? We were solving problems, global digitalization, figuring out we sequence the coronavirus and so forth. I think the same thing now. We've had this incredible decline. We have so many more problems now. Supply chain, Russia's invasion of Ukraine. Innovation solves problems, and yet these algorithms and very short-term time horizons. Ours is 5 years. The market in risk-off goes to 1 quarter. Algorithms are dominating the market. It's very interesting. Most people don't know what our companies do, and they don't know the kinds of problems they are solving. But as we've gone through this period, the 75% decline, we've concentrated from 58 names to 33 names, to our highest conviction names. Typically, that's a very good strategy for the turn in the market.
Wood believes the Fed rates will decrease, but says it's currently showing signs of extreme weakness. Wood believes that we are currently moving into a serious recession. The only difference is we don't have access to the systematic excesses like in the pre-08-09 mortgage market. She says that the Fed doesn't care what happens to the economy now, and they're overly focused on inflation. If Wood's interpretation of deflation as cyclical is correct, the coming deflation will actually be a good environment for the financial market's growth. What do you guys think about Cathie Wood's market outlook for this year and how the Fed is handling inflation indicators? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.